partners.
One of the things that businesses go wrong on social media is they go in trying to sell.
The international community.
All around the world then, there are all these barriers to finance. Not everybody has a bank account, not everybody has identity.
Arts, music, sports, culture.
We don't need to get back to normal. This is an opportunity to us to relook at our society and how everything is done.
And for the first time, government and various government institutions.
We have brought all the SME in manufacturing.
Yes.
And we advocate on their behalf.
Welcome to Biz Talks Season 2 with MC.
I have always had as a concern is what to do with your future. Have you seen people who sometimes get caught flat-footed because they were never planned well their future? That's the conversation. Once we asked people, what would you like to hear? And this is a poll that has been run across some other people who also do business. It's how do we plan for a better way of retiring? And when we had that, we said we're going to have this kind of conversation and start it off well. So in the house, we have an expert in that field, and that's none other than Rose. And I'm so happy that Rose is here to help us off. Rose, welcome to the show.
Thank you for having me.
It's good to have you here. And before then, right here at the show, what we normally do is that we serve some tea. So I'd like you to sort of make a choice of what you'd like to have from our chest of Melvins. Have you made a choice?
Yes.
What are you going to have?
I'll have green tea with mint.
Green tea. Please pick it out. You can put it up in the pocket. Are you going to have it with some hot water, or do you want some milk in it?
With water only.
Just water only. Fine. Lovely. So as I told you, I mean, a lot of concerns people have is what lays in the future. And I think a lot of people sometimes may feel comfortable without really knowing they need to. Please just bring it closer so that I can serve you. So there's a lot of concern on what lays up in the future, and we really hope that today's conversation will enlighten people really and on the importance of what they need to do. So if you're watching us, kindly let me know where you're watching us from. Talk to us. Have you started planning for your own future? What are you doing? What are your questions on matters retirement? I would like to hear that. And keep me company. Remember, we are live, and it is important to tell a friend to tell another friend that the conversation is ongoing. So great to have you here, Rose, and I can't wait to really get into this conversation. So definitely, before we just dive in, would like to know you. So when people ask who Rose Wakiria is, who do you say you are?
I describe myself as an author, a financial and retirement planner. I'm also a parent to a young adult. My background has been in financial services. I worked in the insurance industry, primarily in the retirement benefit space for 17 years. And I encountered people at all various stages, when they're starting out their careers, middle career, and even when they're retiring. But I had one conversation with retirees who we were providing retirement income. And they told me they wish they knew better. They would have planned for their retirement. So at that point, I had this idea of leaving employment to go and do some business, but I didn't have a clear idea on what I should do. And I was like, this is something I can do. So my motivation came from people in retirement who had very good jobs while working, but I was surprised to learn that they were struggling. So I wondered, if these ones are struggling, then probably I would be able to help others to prepare well.
Many others. No, you're right. And I think let's just paint the picture as it is. A lot of people, and I'm not trying to point out our fingers at anyone, a lot of people at their old age sort of have kids as the retirement plan. Let's just put it, I think it cuts across especially a lot in Africa, if I may say that. And I understand. I met one of my mentors, and he said kids should never be a retirement plan. In fact, parents in a way should support their kids. That's a very sensitive subject in itself. But we have seen a lot of people who sometimes were well off when they were working, sort of degrade, if I may use that word, in their retirement, and you would wonder why. And so I would want to start this conversation by asking you, why is it important for anyone watching today to think about their retirement? Maybe they haven't been convinced enough that they need to start thinking about this.
Yeah, it's important to think about retirement because life comes in seasons.
Yeah.
You spend about 20 years or 25 years growing and developing, gaining skills, and then you enter the job market. And for a few decades, probably if you're fortunate, you'll have about 4 decades, maybe from 20 to 60, you'll be working. But there comes a time when you'll stop working. And probably people in business, they normally say, okay, I don't intend to retire, so I don't have to plan. But there'll come a time when you won't be able to do what you're doing for an income. Either because of old age or ill health, or you could actually go out of business. So it's important to note that that will be a period when you'll be vulnerable and you need to have an income to support your lifestyle. Now, going back to your initial comment on children, I usually say if you as a parent did not prepare well for your retirement, I always wonder why you'd expect your children to be in a position to support you. Chances are they won't, because probably they didn't learn from you. But even coming
that's a very important point, that parents should as well be the teachers to their kids to plan for their retirement.
Exactly.
I think I wanted that to sink in.
Yes, I mean, growing up, you learn a lot from your parents. So if probably they didn't learn much or they haven't seen you do much, chances are they could also be in the same problem. So it's important to prepare so that your lifestyle, you don't experience what we call old age poverty, because that is very real. Majority of the people's standard of living actually go down on retirement. So it's good to utilize the years you're economically productive to recognize that the income you earn during that time is not just to support that period, it's also to support the next period, which will be retirement. And retirement can be a long time.
All right. I want to pose at that because I can't wait to ask where to start and how to start. And I want to allow our viewers to share this conversation. So if you're watching, I've even sent you as well, so you can send to your community. So if you're watching from wherever you're watching from, please share this conversation. I would like to know where you're watching us from. It's always good to have company with you. Are you having your cup of tea or something, or where are you? And I just want to also get a comment on the comment section. Have you started planning for your own retirement? And if so, how are you doing it? That would be very interesting to know. So tell a friend to tell a friend that this is a very important conversation. And did you just hear that? If you're a parent and you're watching, your kids are watching. So don't expect them to be super well planned if you're not showing them how to plan that. All right, I think that brings to it. And so now the question is, when is the right time to start, first of all, before we talk about how to start? When is the right time to start thinking about retirement?
Retirement planning being a very long-term goal, it's important to start right at the beginning. Because like the RBA, former CEO of RBA, like saying, the first day of employment actually marks the beginning towards retirement. You're actually one day closer to retirement. So I encourage people to start as early as possible, preferably with your first check. And this is because retirement planning will not just be an achievement goal. It's not something you work towards, you say, I'm building a fund, but it's a habit. You'll have to sustain this throughout your working career. So it's important that you start as early as possible. If you didn't start early, then the right time to start is today.
Before I get to the how again, how bad is the situation from where you see it when you look around, especially here locally? Are people really planning? Are they beginning to do this, or the situation is still dire?
It's interesting. Most of my clients tend to be in formal employment. So these are people who probably the employers have retirement benefit schemes. Or probably they work in organizations where there are no retirement benefit schemes, but they actually earn good money. Majority of my clients are not well prepared. Majority of them are not well prepared. And then it's interesting to note that only about 19% of the workforce is in formal employment, where you'll find majority of retirement benefit schemes. So basically we are saying about 80%, more than 80% of the workforce are not making retirement plans with dedicated assets to retirement. Because that's what a retirement benefit scheme is. The assets are dedicated for you to access them on retirement age. So if you're investing in land, you're investing in anything else, chances are you can access those funds at any time if you need them. So it's not an interesting situation. And even those who are planning, majority of them are not planning enough. If they were to retire, there would be a very drastic drop in the level of income. So it's important that we prioritize this, because if you're struggling now, just imagining struggling even more in retirement.
At your old age.
At your old age, yeah.
This is a tough one. So I think let's get into the conversation of, and this is really sad. Those statistics are quite worrying. I mean, 80% plus, not really almost doing well on that. That's sad. In fact, now I can't imagine in the informal sector, which is now holding the majority of the people, and quite a number of the people even watching as well are probably in those sectors. They don't have those particular employers who already have schemes with them, and we'll be talking about schemes later on. So where should they start, in your opinion? Where should they start?
In my opinion, I would say it's important to seek information, and I think Retirement Benefits Authority is one of the institutions that really provide that. Yeah. Seek information, walk to providers. There are many providers in the market, insurance company, life insurance companies that offer pensions. It's important to have that conversation, and also seek out people like us who do retirement planning. We actually help people to create those plans. Yeah. And then start saving in a dedicated investment plan for retirement, such as a pension plan. And there are many. We have even some for the informal sector. For example, the one by Retirement Benefits Authority. So seek information. In most cases, when you want to find out about something, you actually go ahead and do it. I think it's just recognizing that retirement planning is important and actually making a step to seek information, to find it and to start. And it's very easy to start. Okay. With as little as 500 shillings, you can start saving towards your retirement.
And I think it's very important, as you're saying, there's so many things that we've seen that are upcoming where people even now within their mobile phones can start actively participating and planning for their retirement. You know, let's just address the critics before now we get into other details. There are people who say the future belongs to the Lord. It's okay. I'm not trying to dispute that. And there are people who think if you start planning, you're sort of negating the fact that the God that people pray to will take care of you. You know, those kind of things. I'm sure you have come across such people who tell you, hello, all those kind of things. What do you tell them?
And especially Christians who talk about that, I tell them that Scripture has a lot to do and to talk about money. There are over 2,300 verses that talk about money. Wow. And many of them talk about planning. It talks about the future. It talks about saving. Remember the Proverbs verse that talks about the ants? They save, they put their food during summer because winter is coming. Winter is coming. Retirement is our winter. So God has given us resources and wisdom. And he expects us to steward these resources well. Absolutely. Because one of the things the Scripture again says is that someone should take care of their families, or you should take care of your responsibilities. Absolutely. Paul took care of his responsibilities. So we are supposed to ensure that we are not dependent on other people. We are not a burden to other people. You're right. And that means then we must keep something aside for the future. Okay. Again, Scripture, if we are to go into Scripture, I think there's just too much. Scripture talks about counting the cost before you build a tower, which is basically your financial life. I know. Then you need to count the cost. So you need to know where you're going, and then you need to know what do you need to ensure that you have that comfortable life. So Scripture basically is not against planning. What it's against is putting our trust in those resources. Okay, So make the plans, but remain obedient to God. If he tells you to take it and give it to somebody else or to do something with it, you should do. Okay. But we need to plan.
Lovely. I think I love that. There is no better way to emphasize on the fact that Scripture backs the fact that planning is important. So one of the key questions is achieving the balance between making sure that you're enjoying your life, because there are people who say you are denying yourself. Others think there's a YOLO thing, you only live once. But you know, you want to achieve that balance of making sure you enjoy your life and also put something aside while thinking about your future. How can people achieve this balance?
Actually, if you start early, you don't need to put aside a lot of money. If you start with 5 to 10% of your income, the earlier you start, the better, because there'll be the effect of compounding interest. Okay. So there's an example I've used in my book, Retirement Planning, of a young person who joins the workforce at 25 years and retires at 60. That's 35 years. and they start contributing 3,500 shillings per month.
Yeah.
And that could be fully their contribution or partly their own and employers. And if these investments are put in a retirement benefits plan and they grow at a rate of about 10% on average across the 35 years, and then they just increase their contribution by about 10% every year, at the end of it all, they'll have a fund of 20 million.
Oh.
Now, 3,500 shillings per month isn't so much even for somebody who is earning 3,500.
You're right. Some people will wipe it out on a table.
Exactly.
Yes.
That's entertainment in one weekend or a nice outfit or something like that.
Yeah.
So the best thing is you need to make savings of about 10% towards your retirement plan. And of course, if you have an employer who is contributing, then that makes it even much easier.
Yeah.
10% is something you can afford. And again, we pay taxes, we pay debts. So it's a matter of priority. If you start saving early and it becomes a habit, you won't even feel it, because as your income grows, it will just be a small portion of it. Then that leaves the rest of your income to enjoy.
Absolutely.
Yeah, to enjoy the
way you want it,
the
right?
way you want it.
So one question, and I think I want us to address the two scenarios that we've spoken about, the people in the formal employment and the other ones who are in the informal employment, or either in employment that don't have contributions happening. So there's people who sometimes have sat down and felt, I see an NSF being deducted on my account, so am I safe? I think that's one end of it all. And then there's these people who are already in particular schemes that have been introduced by their employers. And so I think in a nutshell, I'm asking a lot, where do you start, especially if you're in the informal sector? And even in the formal sector, is NSF enough, or should you consider thinking about getting to different schemes?
Let me start with NSSF. Currently, only organizations with a minimum of 5 employees are required to contribute to NSSF. So that's mandatory. So almost majority of people will have an NSSF account. The minimum contributions are 200 shillings per person, and your employer contributes the same. Now, if you only contribute 200 shillings per month, that's a total of 400 shillings, even if you save for 50 years. That will not be a lot of money. One of my clients who retired recently, of course, she's worked for quite a while, 35 years. When she went to collect her NSSF, it was slightly below 400,000. Now, I don't know how long that can take anyone in retirement.
400,000.
Yes, but NSSF offers you an opportunity to increase your contribution. So you can actually save much more than the minimum. For those who want to save more, you can also save in a private individual retirement plan if your employer does not have a scheme. So this is something you just walk to a provider, sign up, and start making contributions, and then you can contribute as much as you want. Now, the people who are in formal employment and in retirement benefit scheme, majority of them, they start well. I mean, immediately they qualify, they start contributing, probably the employer is contributing, but they also make a number of mistakes. So some of them probably can afford to save more, but they don't. So they lose out on opportunity to grow their money. But the most common is when people change jobs. The law allows you to access part of your fund. And majority of people access their funds. The most unfortunate thing, and I see it with my clients, especially those in their 50s, who are like, every time I change jobs, I accessed my money. And I bought land, or I did something with it, I went on holiday, consumption basically, for majority of them. So by the time they're retiring, they don't have much. So you've worked for 25 years, but you're retiring on 5 million, and your lifestyle is quite high, so you're not able to sustain that kind of lifestyle. So in both cases, we still see people not making the most of the opportunity, because you can save more, you can leave your funds invested, but there's also the mistake at the point of accessing the benefits. NSSF currently is what we call a provident fund. You're allowed to access all your money as a lump sum. And we know not very many people know how to manage a lot of money. They struggle with managing money.
You're right, because I'm thinking this way. You know, you have been in employment, and all of a sudden you want now to jump probably into business, and all these years, and it's not to play around with it, because people sometimes can think it's just easy. You'll just open up maybe a supermarket or something of that sort, it flies. And a lot of people have sunk lost all their retirement out of it.
Exactly.
And I think I'll be asking you later on, but go on, you're talking about the Provident Fund.
Yeah, so that's the main challenge with many people. When they access their benefits, they access them as a lump sum, and probably they don't have a solid plan on how that money will either grow or sustain them for the rest of their lives.
You're right.
Yeah.
So let's assume this, and I'm trying to think practically here. I earn 50,000 shillings every month, and of course now I want to contribute so that at least my retirement is somehow flowing. What is this sort of like? Okay, we've talked about the 10%. When I retire, should I maintain the same lifestyle of earning my 50, or should I aim at, what is the best? I don't know. Should I just be able to say, okay, if I'll be getting my 30 maybe monthly or 50 monthly, 50 definitely is what you were earning, what would be the most comfortable in your opinion?
I normally say it's good to define the lifestyle that you want to live in retirement.
Okay.
Because it's a lifestyle. Where do you want to live? What do you want to do? What will you be eating? I mean, will you be going on holiday? So it's important to define that.
Okay.
And since majority of us are not very good with maths, it tends to be, some people just can't go ahead with it. It just looks complicated. So just to say, use current cost.
Yeah.
What kind of lifestyle would you want to live? Cost it.
Yeah.
And then using that, then what it means is that for every month, basically you need to be taking care of a month in retirement.
Yeah.
Because you're likely to live 20, 25 years or even 30 years.
Extra.
That is almost the same amount you're probably going to spend in your career. So you need to ensure that you're taking care of a month in retirement. But for you to make it easier, then you start saving early so that there's a huge contribution from the interest.
Okay.
So that you really don't have to build the exact fund that you want.
All right.
So the lack of clarity with majority of people when it comes to retirement planning is because they can't even envision that life in their 60s, in their 70s.
Yeah.
But we need to simplify it and just decide, if I was retired today, assume all my children are independent.
Yeah.
What will I be doing? Will I be in Nairobi or will I go up country? What is the cost of living in up country? And then you aim to build that income. Of course, we need to factor in inflation.
Okay.
But it's not that complicated, but you need to define the lifestyle.
Okay.
You don't have to maintain the same lifestyle you enjoyed. Most people have actually found that when the children leave home, they actually need to downgrade.
Oh yeah, that's true.
You'll probably not be going to work every day. You'll not be eating out every day. You'll not need to buy expensive clothes. You don't need all that much. So for our market, we normally say it's important to aim for at least 40% of your final income. That would sort of, for majority of people, they'll be comfortable with that. Basically, that's what you call the income replacement.
Okay.
So if you're earning 100,000, so at retirement, then you need to aim for at least 40,000 as your income. Of course, the higher the amount, statistically, we normally say you should aim for 75%. Then that means your standard of living would just almost remain the same, because you'll not be saving for retirement and you'll not be paying taxes. So the 25% component would go to that.
Okay, lovely. I think I like the way you're bringing it out. And one of the other things is, I think you've touched on pensions. And one of the key things that people sometimes complain about is that they don't understand these things. And let's get down to the 101s of what are pension schemes, first of all, because we have people probably who could be getting this by the streets. They've heard people talking about, I contribute to pensions and all those. What are they, and how do you just get to choose one so that you can enroll?
Okay. Yeah. Actually, that's why I wrote this book. Because...
And can I take a look at it? I don't know whether my team is able to just show Retirement Planning, a holistic guide to a satisfying season. Everybody wants this, definitely, by Rose Wakiria. Why is the umbrella there? Is it like a cover or something?
Umbrella is like a cover, a protection, which protects you not only from the rain, but also from hot sun. So when you create a retirement plan, basically you're providing protection against the old age poverty, amongst other things later in life,
All right. Have you seen the book? Excellent. Where can people get this book?
This book is available in a number of bookshops. You can get it from Rafu Books, you can get it from Kibanga Books, African Book Hub, Fontana Bookshop, some Naivas branches like Prestige, Capital Center, and Gateway Mall. And you can also get it directly from me if you'd want to get one from me. So I wrote that book. Basically, when I started, I wrote it for my clients because people say pensions are very technical.
Yeah.
So I just decided, let me write this in plain language. So this is, I believe it's very easy to understand. Majority of people have attested to that.
Yeah.
But a retirement benefit scheme is just a vehicle that is designed to help you save for retirement. And the fact that it's designed to help you save for retirement, it comes with several advantages. And the primary advantage is taxation. So the money you put in a registered retirement benefit scheme, by registered we mean it's registered with Kenya Revenue Authority, and it's given a tax exemption status. What you contribute to that scheme up to a limit of 20,000 shillings per month is tax-free.
Okay.
So this means if you're earning 100,000, they deduct 20,000, which is inclusive of NSSF.
Yes.
And then the balance is taxed.
Wow. So actually you'll be saving a lot of money on your taxes.
Exactly.
Because they will not touch on your retirement savings.
Exactly.
Okay. You said up to 20%?
Up to 20,000.
Or 20,000 per month.
Or a third of your salary, whichever is lower.
Okay.
Now, what that means is that if you're not saving through a retirement benefit scheme, every other investment you make comes from taxed money.
Yes.
So it's very hard for those two returns to actually compete. Then the investment of that up to 20,000 shillings per month, when the providers invest, they get a return. Again, the interest is not taxed. If you invest in anything else, the gain is taxed. So again, this fund grows much, much faster. And again, when you're also accessing the benefits, there are also some tax-free amounts. And if you are retiring, part of the income you actually receive from your retirement benefits, which is actually 25,000 shillings per month, is tax-free, and they only tax the balance. And the tax brackets again are much better compared to the payee rates. So for instance, if you're retiring and you can get an income of 100,000 shillings per month, you'll actually pay just about 4% in tax, because the tax-free amount and the tax brackets are very wide. So that makes retirement benefits the unique product, in the sense that you're using tax-free money that you've not paid tax on, and the growth is also tax-free. And then you make contributions in small bits, just a small percentage of your salary. If you need to buy land, for example, you need to accumulate a lot of money to buy, but you can save 500 shillings, you can save 20,000 shillings, you can save in small bits over a long time. The other advantage with retirement benefits is the way they're invested. There's a lot of regulation around how to invest retirement benefits, which ensure security of your funds. They also ensure that your fund is growing and it's accessible when you need it. Now that makes it very different from majority of other investments.
Wow. I think the bottom line is you're saving a lot, especially because taxes go and then go. Once they go, they have gone. Let me just get to some of the comments I'm seeing here. I think I can see, even people have already shared the links to the Kibanga books. Amazing. So thank you so much, Evans. Evans is tuned in. In Umoja, Nairobi, thanks a lot. Geoffrey Lemba already asking how I should invest in my retirement savings. So maybe you have received already something, I see what you're asking. And sorry, you will hear some of this noises. I think we have had just a power cut, so that's the generator just popping up, no worries. So awesome. So which are reliable pension organizations that one can work with? I think these are questions that are just popping up as we go. But before I get into your questions, please allow me to also ask my own. I have a few more. And I love that this is more like an establishment before we proceed on. So you talked about, I don't know whether I had that word, but there's something called replacement ratio. I've just had it in the retirement angles. Please expound to us, what is replacement ratio?
We call it income replacement ratio. So when you're in employment or in a business, you have an income that you normally receive. And when you retire, then you need to replace that income. So that can come either in form of a pension from your retirement benefits or from investment income. So when we say we are aiming for an income replacement ratio of 40%, we are saying if you're earning 100,000 shillings, you need to at least have 40% of that 100,000, which is 40,000. If you're earning 10,000 shillings, we are saying you need to aim for a minimum of 4,000 shillings.
Wow.
That is what we call income replacement, because you're replacing your salary, so to speak, with a pension or an investment income.
Okay.
So that basically should ensure that you're able to take care of your needs in retirement, which are basically, like we mentioned, ideally they're normally lower than when you're working.
Okay.
Yeah.
That makes a lot of sense. I had those terms and I wanted to understand them. So let's get back to the pensions. And one of the key questions people ask is, what are the factors to consider when choosing a pension scheme? Because I hear there are several people who will tell you, you know what, this is the best scheme, this is the best scheme. But I'm sure there are parameters you could help us understand. When choosing a pension scheme, at least these are the bare minimums.
So pension schemes are very regulated. The products are almost identical amongst all companies.
Okay.
But there are two major differences. The first one is the risk profile. We have two types of retirement benefit schemes. There are those which have low risk. We call them guaranteed funds, in the sense that your capital is guaranteed and you're given a minimum guaranteed interest rate.
I feel like most people would go there, but go on.
Yes. Now, those ones are offered by insurance companies.
Okay.
Now, the schemes outside insurance companies, they don't guarantee your capital and they don't guarantee a return. They actually give you whatever return they make.
Yeah.
So majority of the times they'll make a positive return. But in some severe situations when the economy is doing really bad, they can actually make a negative return.
Okay.
So it's important to know your risk appetite. Are you the kind of person who can withstand the ups and downs, even if they're not so many in this country, but they happen? Or would you rather be in a guaranteed fund? Then the other thing that you need to look at is once you identify which scheme and then you start evaluating the providers, there's the return that these companies make. Remember, they're given these funds in as much as they are regulated where they can invest. It's broad guidelines. Each company will give a different return.
Absolutely.
So some are very good, some are very consistent, some are struggling. It's important to identify.
So there's some work to be done by the person who is choosing to choose a scheme, right?
Just like you do some work when you're choosing a bank, to open a bank account. But if you need help, that's where we come in, and there are many also financial advisors who can help you with that.
Okay.
But you also need to look at the stability of the companies, the kind of service that they're giving you, and that I've addressed actually. That I have dedicated a whole chapter in this book on how to select a provider. So once you know your risk profile, then do some research. You can work with independent advisors like ourselves, where we are not affiliated with any company, and we'll give you a variety of options. But if you are also probably doing some business with a certain company and you know how they are, you can also approach them. So for the guaranteed funds, they're offered by life insurance companies. And those are about 22 or so at this time. And you can actually pick from any of them. And that information is also available at the Retirement Benefits Authority website.
Wow. Lovely. I think I love that. So there's some homework for you. Don't just jump in, go do a bit of reading or ask questions, and if you really can't get these things, call Rose. She'll be there and she'll help out. I'm sure by the end of this conversation we'll talk about how people can reach you so that at least they can get to understand more. So I'm just going to read some of the questions. When I told people we're going to be talking about retirement, there were some questions that they sent me out, and then I can go to the comments section. So feel free to start even sending in your questions. Listen to this one. Is it advisable to take an annuity in retirement or invest in other ways like treasury bonds? First of all, define terms here, because annuity sounds nice, sounds like a jargon. What is this person talking about?
So an annuity is an insurance product that you can use to convert your savings into an income for life.
Okay.
So you come with your 2 million, an insurance company will quote for you depending on your age and your gender, and then they'll tell you you'll be receiving this amount of money per month or whatever frequency you choose for the rest of your life. So the advantage with the annuities is that they guarantee you an income for life.
Every month.
Every month. And in event of an early death, you can actually choose a minimum period which they must pay, whether to you or to your next of kin. So you won't lose out on your money. If you live long, to 70, 80, 100, 120, whatever age, the insurance company has made a commitment, they will pay.
Wow.
Now, that guaranteed income, I always encourage people to have some of it there. Because you need to ensure that your basic needs are covered. So housing, food, maybe if you have chronic conditions, you have to see doctors often. You can ensure that your medicine expenses are covered. You can also invest in other investments like bonds. So bonds, if I may give an example of treasury bonds, they are offered by governments. The government will borrow money from the public, and they promise to pay back that money after a certain number of years. But in the meantime, they pay you an interest every 6 months. Now that interest can actually become a source of income for you. So I encourage people to have more of a diversified portfolio where you have some annuity, you have some bonds. If you're interested in property, you could have some rental income. You might be doing some little business, but it also depends with your understanding. Not everybody understands. But I think Nairobi Securities Exchange, amongst other organizations, have really tried to educate people on the bonds. And there's even some bonds you can buy with very little amounts. I encourage people to start investing in those assets now, so that you learn them and then you see whether it will fit you. So if you choose to go the bonds way, one of the things we encourage is that you layer your bonds, so such that you can actually have an income every month. So what I mean by that is, like, buy a bond in December, it will pay an interest in June and December. Buy another one in January, it will pay in February, and in
sort of like every month will be covered somehow.
With time, you will have like a parallel salary. And those are things you don't have to wait until retirement to do. You can actually create that now to take you in retirement. But then again, when the bonds mature, you need again to reinvest them, or you can actually use the proceeds again to buy an annuity to continue providing you with that income. So it depends, and that is where, as a retirement planner, I come in. I sit with you, I look at the goals that you have, and then we design what will be best for you. For some people, it is very important that they take an annuity, probably because of the responsibilities that they have, which require a guaranteed income. For other people, they can buy an annuity, and they can also do bonds and other investments.
Wow. This is quite mind-boggling. I'm also thinking, what is better? Sometimes it's easy to run to the safety, but I think there's something you have said. Sometimes it depends on someone's goals. You want to sit down, evaluate, and see what is important. But I think diversification is important.
But in retirement benefits, it also depends. If you're in a pension scheme. Now, retirement benefits is the broad term, but then you can have a pension or a provident fund. I think earlier I mentioned NSSF is a provident fund. You can access all your money as a lump sum. Now, many schemes are actually pension schemes, which cannot allow you to access all your money as a lump sum. So the rule is that you must access 2/3 as an income. So for a number of people, they don't have a choice. They have to take an annuity or what we call an income drawdown. So majority of people, and also depending on the amounts that you have, will actually take an annuity. So some have no choice but to take an annuity. You can't actually decide, I'll take my money and put it in other investments.
There are policies that people save with. Some of them are called life policies. I think the education one, I understand, is just for education. But with someone who sort of like has a life policy, sort of be planning for their retirement, or is it just a policy that probably would not benefit them? I would like to hear your comment on that.
There are various products in the market, and insurance policies, they have been used. Some people have used them as a retirement plan, in the sense that you can save some money while you're still also getting protection. In the event of death during the period, then the next of kin would be paid. But if you survive that period, and some people can synchronize that to their retirement age, then you'll get a lump sum for those policies with a final maturity, a big payout at the end. And then you can use that as a retirement package. But it's important to compare all these products because they grow at different rates. But for somebody who has a lot of money, there's room for each of those products. And again, remember, what I tell my clients is that you don't look at one goal in isolation. So even as we are thinking about retirement, we still have children to educate.
Yeah.
We still have other things to take care of. So sometimes it is a combination of all these financial instruments that will give you the best outcome. But for using life policies as a retirement plan, I would say it's not the most efficient. It can serve the purpose, but we have a retirement benefits product which is dedicated and designed to actually provide that.
Okay.
So you can cut a tree with a knife, but I think an axe is better suited for that. But if you just had a knife, you'd still bring down the tree.
All right. You know, there's people who argue out and say, I will build some nice houses for in my kashamba somewhere as my retirement plan, you know, or I'm very good, I have prepared a business with that. I want you to address them and tell them why it is important maybe to diversify, not just think on one line. Let's address those ones first.
Okay. Before I address this, I've just remembered something. There's a particular insurance product that is designed for retirement. That would serve retirement purpose. We call them deferred annuities.
Okay.
So basically, you put in a lump sum and you defer access until retirement.
Okay.
Now that serves that purpose very, very well.
All right.
There are few providers in the market who provide it, not many, but it is there, and it has very good returns.
Okay.
Because the money is locked for a long period.
Okay. That sounds good. So let's talk to these people who think I know my plans.
So many people want to go back to the village, like you said.
Yes.
They'll put up a home, they'll do farming, and they think that is their retirement plan. And there's nothing wrong with that, because that is the lifestyle they would want to live. They don't want to continue living in Nairobi if they're not working. But what I'd like to say is that it's not good to put your eggs in one basket. That is basically what we normally say. When you say farming is my retirement plan, we know how farming can be difficult. I mean, you have no control over the rains, you have no control over the pests, you have even no control over the market. You could actually grow your crops very well, but you don't have a good market for it. So the best thing is to actually diversify. Many people go back to rural areas and they do some subsistence farming, some people do commercial farming, but it's also important to have that investment in terms of a retirement benefit scheme which guarantees you a specific level of income. And if you have additional income from your farming, well and good. The thing is, the need to diversify is that most of these products, let's say you have bonds, you have shares, you have property, they don't respond the same way to the market shocks. We saw in 2020, the property market actually, those who are relying on rental income, for some months they didn't have an income at all.
Tough,
But we still saw bonds continue doing well and fixed income continue doing well. So it's important to have a bit on this side and a bit on the other side, so that if one area goes down, which is the norm, I mean, we should expect that. There are market cycles. So at any one time, something will be doing well, something will not be doing well.
So don't put all your eggs in one basket. You're talking about a lump sum, you know, because there are options. For example, if it was a life policy, there could be an option. My quick question to you would be, what would be your advice to people who choose the option of getting a lump sum, you know? And I'm asking this because there are people who make mistakes. I think I don't want to mention names. I have a relative who got a lump sum and they knew what they wanted to do. Started a nice, I don't know, hardware thing, then boom, it's no longer there. 2 years down the line, nothing. And so all the money they had saved for all those years gone with bad advice, I would call it that. I don't know what you would say, and I'm sure you have seen case studies by yourself, people who lost money. What would be your option or advice when it comes to receiving a lump sum?
You need to have a very good, solid plan. And you need to look at your history. How have you managed money in the past? Because it doesn't mean that now you have a huge lump sum, you're going to do a better job. And I've actually addressed that in the book. Should I take a lump sum or should I take a pension? And again, it depends a lot on who you are. If you're good with investments, you've done investments in the past and succeeded, probably, not fully, probably you can choose to go that way. But the biggest challenge with people who take lump sums without a solid plan, which is geared towards providing an income for the rest of their life, is that they become very optimistic. So if they go to business, they probably put everything into that business, which again is putting all your eggs in one basket. But I always say start small, especially when you go into business. business. We know the failure rate of businesses, especially in the first 3 years, is so high. So chances are your business might fail. So you shouldn't put all your money into it. So start small and let the business grow with time while you diversify part of the other investments. And then later you can actually put in more capital if the business proves to be viable. So work with a financial planner, come up with a plan that will ensure that you're taking care of all the issues that could come up. Basically, that's what a financial plan does. You can anticipate what could happen, and if it doesn't happen, then you'll still be in a better position. But please don't take your money, go start a business you have never run before, or start building a house and keep expanding it. By the time, even before you finish it, you run out of money. So you have no money and you have no home. Those are very common things that people do.
So kindly shed some light on how to use my pensions to buy a home. I hear there are ways in which with your pension you can still manage to buy homes and stuff like that.
Of course, housing is one of the biggest needs, and the biggest, I mean, probably the single most expensive when it comes to our household budgets. So to encourage people to have a retirement home, Retirement Benefits Authority has given guidelines on how you can use your retirement benefits to buy a house. So there are two ways. The first one is what you call assigning your benefits. So this happens when you want to take a mortgage. So you approach a lender who is registered with retirement benefits to provide that particular service. And then majority of people struggle with getting the deposit, the initial costs. So you can use part of your retirement benefits as security to the lender, such that the lender is able to give you about 115% of the value of the house. So the 15% would go to things like the deposit, the legal fees, the valuation fees, stamp duty, and all that. So you don't have to look for that lump sum you need to start a mortgage. So the money does not move from your pension scheme. It is just assigned. This, I would call it like, you cannot access your retirement benefits until there is proof that you have settled your debt with the lender. So that allows your pension to continue growing while you're repaying your mortgage. But recently, there's also another option that has been introduced where you can actually move part of your money. You can actually pay for the house. Of course, there are very many guidelines that have been put to safeguard the interest of the members. You identify a house within a certain range, and then you work with your provider, and the money can actually move and pay for that particular house.
Lovely. I think that's well addressed. I want to jump into the questions that people are asking. And one of it, I think, let me start up. I'm just scrolling up. So Evans was asking, which are the reliable pension organizations one can work with?
Now, without favoring any, I am just mentioning schemes. The insurance companies, like I said, there are 22 companies. There are most of them, 22 companies have retirement benefit schemes. So we're talking of the big companies, the Britam, the UAP Old Mutual, Prudential, Jubilee, ICA Lion. I mean, the big names. Actually, if you walk to any of those companies, you'll be able to find them. But you also have those who are outside the insurance industry, companies like Zamara, Octagon, amongst others. I would suggest just go to Retirement Benefits website, and you'll actually be able to see a list of registered individual retirement benefit scheme. If you need specific advice, then again, you can reach out to us and we'll be able to help you with that.
Warambo in Westlands is asking, what's the least number of years I can save?
You can actually save until age 75. So at age 75, you must access your retirement benefits. So you can save for a very long time.
As long as you can, right? So let's get to some other interesting questions that I'm seeing here on the side. Let me read out as it's coming. So I think we've talked about buying a home, which has been addressed. I'm trying to sift through so we are not repeating. Someone is asking, what again is the difference between a provident fund or a pension. Would you like to say something on that quickly?
Yes. So a pension, basically when you join a scheme, you join one of them.
Yeah.
It has to be either a pension or a provident fund.
Yeah.
But in most cases, they operate the same way. But the difference only comes in accessing your benefits at retirement. On retirement. So a pension scheme allows you to access up to a third of your fund. So if you have saved 3 million, you can access up to 1 million. You can decide not to access. All right. But if you want to access a lump sum up to 1 million, and 2 million has to buy an income in form of an annuity or an income drawdown.
Okay.
And that the government pension is fashioned the same way.
Yes.
I mean, when people are retiring from the public service, you can access a third, and then the balance comes in form of an income for life.
Okay.
A provident fund, again, you can access everything.
Yeah.
Once you pay the relevant taxes, then you take home the money and decide what to do with it.
Okay.
Yep.
There you have it. So I think it's Jane, and she's saying that I'm in business. What do I do?
Yeah, I want to address the people in business, and we know business has its ups and downs.
Yeah.
And what I would encourage people to do is, when the business is doing well, the tendency is to plow back all the profits back into the business, and then when something happens to the business, you end up losing everything.
Yeah.
So I would encourage you to set aside some money from every income that you get.
Yes.
And basically that's what people in formal employment do. So you can decide, I'll be saving every month 10% or 5%, whatever percentage you decide.
Okay.
And then I would encourage you to put that either in a retirement benefit scheme or in a deferred annuity. So for example, if business is really good, and you can afford 500,000, you can afford $1 million for your retirement, you can just approach retirement, an insurance company, get a deferred annuity, and specifically that money will be saved for retirement. You will be able to access it when you want to access. You actually set a time. You say 15 years, 20 years from now.
Absolutely.
And that money will grow. For instance, if you keep, there's a client who was running late. She was almost 50. She didn't have a retirement benefits plan. She had some 4 million. We're able to put it in a deferred annuity. And in 15 years, she'll have 19 million. Wow. So she can actually comfortably say, my retirement is almost taken care of.
Okay.
So, of course, the higher the amount, the more it will grow, but that is one product. If not, please approach an insurance. Maybe I can direct you to an insurance company.
Okay.
Walk to a life insurance company and tell them that you want to start a pension plan.
Okay.
It is very easy. It's a simple process to sign up, and then you can start making your contributions.
All right.
Yep.
So Hilary Phillip is asking, please share the difference between annuity and income drawdown.
Yes. So an annuity is an insurance product. So it's only offered by insurance companies.
Okay.
And it is pegged on your life or also on the life of your spouse.
Yeah.
So what this means is that on retirement, you have your 3 million, you walk to an insurance company and you tell them you want an income for life. But if you want what you call a joint life, you can enjoin your spouse, so it can pay until the last of you passes on. Okay. So if you die first, it will continue paying your spouse the same amount or a reduced amount for life. So it's an insurance product. Once you put your money there, you can't get it back. That's it.
All right.
An income drawdown, on the other hand, is like an investment product.
Okay.
It's actually like the reverse of saving for retirement. So you approach a provider, this can be the same scheme you are in or another one with a lump sum, and then they invest that money, but you are also able to access that money on a monthly basis.
Okay.
So there are two rules that guide an income drawdown. You must access an income for a minimum of 10 years.
Okay.
And the second rule is that you can't access more than 15% of the fund in any 1 year.
Okay.
But you can structure it to provide you with an income for much longer than 10 years.
All right.
So in annuity guarantees you an income for life. Income drawdown, we can say guarantees you an income for 10 years.
Yes.
But you can structure it for longer. So in terms of advice for somebody who's probably considering that, we encourage people who have other sources of income. If they wish, they can take an income drawdown. But if retirement benefits is the only source of the income you'll have in retirement, please go to an annuity. Take an annuity.
Okay, that's a very good question, Hilary. And I think it also expands and helps us out. But I think Hilary said this is a very important talk. Thanks for sharing the information. So now there's another question. I think I'd seen. I'm trying to just quickly scroll it out. Sorry about this. And now what should one do once they choose to take full cash out as a lump sum? I think we've addressed that. So I would want you to go back there. I think there's a lot of advice on what to do with a lump sum. But if we get minutes, because I think we have about 5 minutes, we will consider maybe whether to answer that. Then what are some of the tips? Oh yeah, for parents now. Parents who have young ones, on raising them well. Since we actually started by saying, you're the best example that kids should follow. What would be the tips to parents who are watching?
Exactly.
Yeah.
So it's important to know that kids have you as their first authority, and for quite a while before they become young adults and maybe in their late teens when they look for information out there. Yeah. It's important to teach savings habit right from an early age.
Yeah.
When you give them 100 shillings, teach them to save some money.
Yeah.
So that it becomes a habit. Let them know what you're doing to a certain extent, of course. I'm not saying that you disclose all your information to your children, but let them know it's important to save and what you're doing about it so that they can learn from you. If you don't take care of your children, they're actually one of the main reasons why, even if you have a good retirement plan, it might not work. Because if they're not independent, they're taking longer to get out of home, then it means the little income you have to share with them. And we've even seen instances where young people are getting rid of their parents so that they can have something. So it's important that we educate ourselves first as parents. The financial literacy level is very low in our country.
Quite low.
About 38%. Out of 10 people, 4 people do not understand the basics of finances. So first you need to educate yourself, and once you're well educated, it becomes very easy to pass that information. So helping them with simple saving products, even the ones we find in the banks. I mean, you can open for them and you can encourage them to save. As they grow older, you can introduce them to other investment products. As they start working, find out what are you doing for retirement. I mean, just keep talking to them and they'll keep on thinking about it, because what we find is that many adults, many people in their 40s and 50s, one of the things they're struggling with right now is to take care of their parents. And that now affects their own preparation for retirement.
You're right. And they say a lot of families are even a sickness away to poverty because there was no plan. But how do you plan on your retirement, because you're prone to some of these chronic diseases? What would be your advice, especially for people who are now clicking 50 something to 60? There are some things that will kick in, and there's some chronic diseases that could hit them, and oops, whatever money you had, oops. What would be your comment on that?
I would say you need to prioritize post-retirement medical just as much as retirement income. It's something you actually need to do along the way. As you're saving for your retirement, please save also for medical. So recently, again, the regulations have allowed people to have that post-retirement medical. So as you're saving for your pension, you can actually have a parallel saving for medical. Because, like you said, one illness, we've seen what has happened in the last 2 years. People clocking bills of 3, 4, 5 million. That leaves people with nothing, basically nothing. So it's important that you save and prioritize that, because healthcare is just becoming more and more expensive. So having dedicated assets, you can save in retirement benefit scheme, but it doesn't have just to be there. You can save in bonds. You can put some money, build a portfolio in bonds over time. And I'm not accessing this money, but in case of an illness, please go and sell these bonds and take care of my healthcare. Because bonds are you can easily trade them in the stock exchange. So it's having, just like people set aside resources to educate their children, set aside resources for your retirement income, set aside resources for building a retirement home, set aside resources for a post-retirement medical, whether it will be in terms of insurance, which is also expensive, as well as paying out of pocket for your health care.
That's a good one. Finally, as we are about to end, I still have some 2 minutes. Let's address what age gap is it that I feel like it's late? A 45-year-old who's not even started thinking about this and it's boom. Is that too late? I don't know.
It's never too late.
It's never too late.
It's never too late to start planning for retirement. And actually, many of my customers are around this age. At 45, they realize, now retirement appears real. And you're sort of in your mid-career. And probably your income is also a little bit high. So it's not hard. All you need is proper advice so that to ensure that you're putting your money in the right investments, you still have about 15 years or even more. You can still be able to save. Even if you're 50, I mean, just start saving. There's no limit to what God can do with your little savings. So start wherever you are. It will definitely help in one way or the other.
I have a final thing I would like you to do. Just give us one case study of people you saw who have retired and they did well. You don't have to mention names. They did well, and you know what, they did a proper planning, and you look at them and you say, wow, this ones knew what they were doing. Do you have an example?
From my clients, I think my oldest client is probably retired for about 3 years. One of the things that will probably help her stay comfortably in retirement is that one, she worked for one employment for a very long time, so she didn't make the mistake of accessing her benefits as she left. So by the time she was retiring, she had a very good income that was able to replace close to 60% of the salary that she had. We sat down, we came up with a plan, and we were able to work out a plan that would ensure she has guaranteed income, but she also has investment income. She had also clearly thought about what she will do in terms of after retirement. So she engaged into something that she used to do earlier on in her career. And so she is mentally engaged, she is interacting with people, not too much at her own pace. She's under no pressure to work so hard. And the other thing she also did is that she has a very good support, social support. So retirement is not just financial.
It's not just financial,
It is both financial and non-financial. Even if you have all the money, but you have nothing to do, you're most likely to struggle mentally, and people die out of boredom and loneliness. If you don't have a good social support again, you're actually going to suffer. So research tells us that the main indicators of happiness in old age, they have very little to do with money. So don't neglect the other aspects of preparation, especially the relationship with your spouse, because when you retire, where do you go?
You're going to be stuck with them.
Go home. So you shouldn't be stuck with them. You should be enjoying your time with them. So you need to maintain that relationship. You need to build that relationship. And the relationship with your children as well. Because those are the people who will give you joy. They're the ones who will bring you grandchildren to have company. So I would say the people who will do well in retirement, they're people who start early, remain focused in that plan, and then ensure that they're planning in a holistic way.
I just remembered something as you were talking. I saw a picture of a couple. I think they were in Venice. They had gone to sort of whatever, and they were sleeping. And people are making a comment and saying, I think it's important to travel early, not at your old age. I'm sure you've seen that picture, have you?
Yes, I have. Yes, I have. And it's important. It's true. Again, there are people we call hoarders, people who save and save and save. They don't enjoy today. They plan on enjoying later. No. Make sure you have a balance. Enjoy life today and also plan to continue enjoying it in old age.
All right. So I think Rosemary is very keen to as well get to know how they can reach you. So how can people reach you?
Yes, you can reach me through mobile number 0722 355 464. You can also visit my website. I have two websites, retirementsolutions.co.ke. That is where I help people to set up retirement plans, or when they need to convert their savings into an income. That's an insurance agency. But for my training and consultancy, I have a website, Next Move Consulting. That is nxconsult.co.ke. Just send me an email on rose.wakiria@gmail.com, and then we can have a conversation.
And even if you check on social media pages, the profiles and all that, just search Rose.
Yes, it's Rose Wakiria. You'll find our social media handles.
Excellent. There you have it. It's 9 o'clock now. It's actually 9:03, so we short a little bit. Sometimes 1 hour goes that fast. And so, first of all, thank you so much for your time, and really to appreciate the fact that you made time for us to really understand this. And thank you so much to all our viewers for your feedback, for all the questions, for interacting with us. I think the most important thing that I've picked as well, if not now, then when? So you better start now. Don't wait until it's an awakening call later on in life. Thank you so much for your time. Remember, you can always do this. And there's a book here.
retirement planning. I know she only just touched a little bit of what is here, so I can imagine this book, for example. Like I can tell, this is a very new one, so probably it's mine. But yeah, so reach out to that, and there's also a link I've seen been shared where you can get the books, and she talked about it. So there you have it. Start planning now. You don't want in your old age to be crying and asking questions. Bye bye for now. Best talks.